Hi, everyone. Thank you for joining us during your lunchtime to review how the markets did in Q1 and how our Endowus portfolios performed. My name is Min, and I will be presenting today with Sean, who's our head of investments. I'll take the first part of the session going over a review of Q1 and then taking you through the portfolio performance and handing you over to Sean to go over income, cash smart, and closing with the market outlook. So now if you get into the next two slides, you're going to see our disclaimer slides. So we'll just rest on this for a little bit so you can read them. Okay, the next slide. Okay, so if you have any questions on the portfolios or the markets or anything you want, please go on to Slido and ask your questions. We have the link here and the password that will take you to the Endowus section. Great. Next slide, please. Yes. I think the majority of the audience today will be very familiar with Endowus, but just a quick plug if you're not, Endowus, our mission is to help everyone invest better. Whether you are just a, a young adult starting out in the working world, or if you are a person with a family and a mortgage, or even if you're ready to go on to the next stage of your life where you're ready to retire and maybe start to draw down on your savings. So we're trying to help everyone. And why should you invest with us? Because we know you have a lot of options. You have to invest with us because we offer you the cheapest share classes after trailer fees or clean share classes. Those are institutional share classes that are often only available to corporations and institutions. That is quite rare in this industry. We charge a flat and low transparent access fee. And last but not least, we eliminate that conflict of interest that you may have seen or experienced with other traditional peers. We don't try to sell you products that are expensive or have you sell in and out of investments so as to generate more sales, because we don't have a sales charge. So you can buy and sell anytime you want, anywhere, whenever you want, and as often as you would like, because there is no trading fee. Next slide, please. And here you can see that we are backed by some of the largest and most respected organizations in the world, such as UBS, Samsung, Singtel, EDBI, just to name a few. They invest in us because they believe in our mission as well. Great, next slide, please. Okay, so now we can start the market review of Q1 2023. As you can see here, this is a slide that we show in all of our quarterly reviews. This is an indication of three major asset classes. The first one is blue, which is the MSCI All Country World Index. That represents the global equity markets. And the green is the Bloomberg Global Aggregate, which represents the major or the global fixed income markets. And the orange is actually a commodity index. And just looking at how they've performed, if this is in Singapore dollar terms, the MSCI equity was actually up about 4%. In USD terms, it's actually larger at about 7%. The global fixed income markets were just about flat in Singapore dollar terms, but positive in USD terms. The commodities, however, had a terrible quarter, as you can see by the negative 14%. The only exception, or one of the exceptions, is actually gold, which significantly outperformed most of the other commodities. Energy was one of the biggest losers, actually, for the quarter. What happened was, with the immediate European energy crisis averted because of the benign winter, we saw a lot of the energy and energy-related commodities actually decline. And this is specifically true for natural gas, oil, and coal. And what's happening here too with the European countries making a concerted effort to actually diversify their sources of energy away from Russia and what you would call less dependable partners. So that has really accelerated the transition towards green energy sources, renewable energies, and with that came a rising demand for some of the raw materials that we're seeing a shortage of right now. Next slide, please. So if you just look at the Q1 numbers, you would not remember or know that there was actually a lot of volatility behind Q1. There was a lot of up and down, and something that you would have experienced as an investor during the quarter. So what happened in January was that at the end of December 2022, when the markets ended in a negative territory, we saw the reports coming in, and actually it was much better US consumer price index numbers, higher than expected GDP growth for the US, and a still very strong labor market. And all that helped with the risk on sentiment, and all the equity markets and the fixed income markets took off, and China was leading the pack. So that was January. And then in February, the economic reports came in, and there were new reports indicating that inflation was actually stickier than expected, and that the central banks actually have a lot more fighting or hiking to do just to keep the inflation in check. And the prospect of these more further rate hikes actually led the markets to price in these, and causing them to sell off. And you see a decline in February. And of course, March was an incredibly eventful month. We saw the banking trouble start with Silicon Valley Bank, spreading to Signature Bank, other US regional banks in the East Coast and the West Coast, and resulting in somewhat related, but not a causation and correlation, maybe more of a correlation, in the acquisition of Credit Suisse by UBS. And fortunately, the central banks and the governments were fast to react to some of these stresses and issues, and they were able to boost confidence in the global banking system, and helped to stem a contagion from the banking crisis. And as the banking stresses and troubles kind of dissipated, we saw the US Federal Reserve approve another 25 basis point hike in the later part of March. Next slide, please. Okay, so going from the quarterly performance, we go back to the bigger picture. What you see here are the different regions and how they have performed over the different time periods. This is always a random collection of colors, and that's because it's really hard to know which region will outperform in the next quarter. Q1, Europe was the best performing region. You can see here the top square, possibly because a lot of the negative scenarios that the markets had been pricing in did not materialize. So the energy crisis that they were kind of expecting did not happen, because the winter was relatively benign. Therefore, the energy prices dropped. The ECB rate hikes that we saw, those were totally expected. And with the markets, if it's expected, that means it's been priced in. So nothing unexpected on that front. And that caused more of a risk on sentiment for Europe. The US also had a decent quarter, even with the disruptions and turmoils in the banking sector. The Fed was able to reassure the investors and the clients of the banks that were in trouble by guaranteeing the deposits, etc. So they actually hiked rates twice, once in February and the other time in March, by about 25 basis points. Inflation also rose a little bit less than expected and anticipated, which led to some optimism that the Fed might actually take a pause on the rate hike sooner rather than later. And just we're going to skip a few of the regions just for, in the interest of time. China had a great month in January, but in February and March, the returns were more muted because of the escalating tensions between the US and China again, and that had some impact. And the emerging markets as a whole, as a region, was actually the worst performing region for Q1. And that's also because of a number of idiosyncratic issues that came about from a few of the emerging countries, such as India, with the scandals of one of a large conglomerate in India, South Africa with the electricity crisis, and in Turkey, markets were, they're still recovering, and the country is still recovering from a terrible earthquake in February. So those all impacted emerging markets returns. Next slide, please. And then from region, we go on to the sector. As you can see in the heading, tech is back. And yes, that is true. Consumer discretionary, communication services, and technology sectors were actually the top performing sectors for Q1. They all posted double-digit returns. And you would think that with all the troubles around banking, financials would be the worst performer, but they were not actually. It was largely stable, returning just about a negative 1.3%. Instead, the worst performer was the energy sector, as we had already seen earlier. Next slide, please. And then from the sector allocations, we go to style or growth versus value. This is the chart that we show in all of our quarterly reviews as well. We started the quarter with value stocks coming in really strong, beating growth stocks. But then somewhere along the way, that trend reversed and ended Q1 with global growth stocks really outperforming value stocks by a significant margin. And this is not shown on the chart here, but in terms of size, mega and large cap stocks actually outperformed in Q1. And in March, particularly, large cap stocks outperformed small caps, reversing the trend that was in place in the earlier part of the quarter as investors started to seek safety in well-known names and blue chip stocks. And next slide, please. And that was actually the last slide for equity. Now we move on to fixed income. This chart is interesting. I thought it was interesting because it shows how investors or market participants, as we all are, expectations of the Fed funds rate change with the developments and the changes in the economy and what's going on in the markets, right? So the dotted line you see here is the market implied Fed fund rate. And the gray zone around it is the range of expectations because people have different expectations. We saw how the hawkish remarks by the Fed on March 7th indicated that the Fed may raise rates on the back of stronger than expected economic data, so that you see this little hump here that's going up. The expectations increased. And then they decided to decline a lot more after the collapse of Silicon Valley Bank. And then the market started to price in the possibility that maybe the Fed might pause rate hikes or possibly cut. So you started to see the decline in the rates expectations. And then it just kind of stayed flat until the actual rate hike at the later part of March, where reality met expectations. Next slide, please. And this chart is talking about duration and term spreads across the globe. It shows the 2-year bond and 10-year bond over the past 10 years for major countries. What you see is most of the time, these lines are above that zero line, meaning that, in most cases, the yield curve is not inverted, it's upward sloping. But at some point in 2022, you start to see these lines go below the median, the zero line, where they start to get negative. And when that number becomes negative, it generally means a flattening or in some cases, an inversion of the yield curve. So we see that in Q1, Germany had the largest negative number. And this number is actually the change in the spread. So not the magnitude of the spread itself, but the change in it. And that indicates that it experienced the largest decline in the spread between the 2-year and 10-year yields of all the 4 countries listed, where the 2-year yield declined less than the 10-year, indicating a further inversion of the yield curve. Next slide, please. From term, we move on to credit, another important aspect of fixed income. This chart actually specifically talks or shows the US credit spreads over the years, all the way from 1973 to Q1 of this year. The yellow line represents the long-term median of the spread, which is about 1%, the yellow line. And if you look at the square on the right-hand side, which is a blow-up of the spread over the first quarter, you will see that at the start of the quarter, the the spread was actually very close to the long-term median, right? And then it started to decline in January and February, meaning that the spread that you were getting over the government bond for taking on credit risk was decreasing. And then in March, because of all the issues with the banks, we started to see it spike again, meaning that investors were starting to want more spread or higher yield over the government bond for taking on that additional credit risk. So, and then that, even though that looks like a significant blip when you're actually living through it, when you take a step back and look at the longer term picture, you see that that was a tiny blip compared to what happened in 2020 and 2008. So, that's just meaning that even though things seem really tough, you just have to take a step back sometimes and look at the bigger picture. That actually helps. Next slide, please. From the spreads, we move on to the different sub-asset classes for fixed income to see how they have done over the quarter. Global ILBs, or inflation-linked bonds, had a positive quarter, and they were the top performing sector in Q1, with positive returns in March, as well as real yields fell across the curve. Real yields. It's very hard to pronounce. The US TIPS posted positive returns, but underperformed the nominal bonds. US TIPS would be the Treasury inflation protected securities. In the UK, ILBs generated positive returns, but outperformed nominal. Eurozone ILBs had positive returns, but underperformed nominals, similar to the US TIPS. And as we've seen in the previous slides, duration actually helped in Q1. So having duration and longer duration was beneficial for your fixed income portfolio versus having shorter duration. So you can see that in this chart as well. Credit spreads widen further. We've already seen that, negatively impacting the returns of high yield bonds as investors started to seek out quality names, invest higher investment grade in government bonds, just for safety, following the sharp yields, the falls in the yield in early March when we saw the bank run. Next slide, please. And that concludes the Q1 review of the session, and we can go on to the portfolio performance. The first one up is Flagship Cash and SRS portfolios. They had positive returns in Q1. Actually, is this right? Q1 of 2023. This is showing Q3 of 2022, but if you look at our quarterly review, you will see that what happened in Q1 of 2023 is that the portfolios had positive performance, and in a reversal from the fourth quarter, we have already talked about this, but value stocks significantly underperformed growth stocks in the first quarter of 2023. And because of this, the 100% equity portfolio, even with the positive performance, underperformed the MSCI equity. The MSCI equity returned about, I believe, 5%, maybe 4%. We're going to, okay, so let's see here. This shows the actual performance. So for the 100% equity, it was 5.8% versus 6.6%. And there were a few reasons for that, which I've already highlighted. One was the value tilt because of dimensional funds. And the second one was the tilt to small caps, also because of dimensional funds. As you know, dimensional funds overweight the performance drivers, the long-term performance drivers, such as value and small cap. So those actually did not perform well in Q1, and that detracted from relative performance for the 100% equity portfolio. There was also a slight overweight in EM for the portfolio, and that detracted, as we saw, since EM underperformed the rest of the regions. For the 100% fixed income portfolio, it underperformed the global fixed income markets, But that was really because of some of the duration positioning of the underlying funds. So the PIMCO income fund, for example, had a much lower duration versus the benchmark. And as we saw, duration helped. And having a shorter duration actually really hurt the portfolio. So that's it for the cash SRS portfolios. Let's go on to the CPF portfolios. For the CPF portfolios, they also posted positive returns for the first quarter, but unfortunately, the 100% equity portfolio and the fixed income portfolio underperformed their respective benchmarks because of the same headwinds faced by the flagship cash portfolios, namely for equity, tilt to value, tilt to small cap. Oh, no, sorry, tilt to value, not to small cap, just value, and an overweight in EM. The tilt to value came from the allocation to FSSA Dividend Advantage Fund, which is more value oriented. And the EM came about because that's how the portfolio is structurally positioned. In terms of the fixed income portfolio, it tends to have a shorter duration versus the index, the Bloomberg Global Aggregate Index. And that's really because a third of the portfolio's assets are allocated to the United SGD Fund, which is more conservatively positioned with a shorter duration. And that really helped in 2022. But in Q1, when duration actually benefited fixed income, this turned out to be a detractor for the portfolio. Next slide, please, for factors. Oh, yeah, so this is we'll just click the other slide, which is just a graphical format of what we just talked about, showing that in the longer term, in the 5-year period, to be exact, the portfolios have kept up pace with their benchmarks. So factor portfolios, the 100% equity portfolio, positive returns, but underperformed the equity because of, again, focus on small cap and value stocks, which are long-term drivers of expected return, but in the short term, they may underperform, which happened in Q1. There is also that slight overweight in EM, and that also had a negative impact. For the 100% fixed income portfolio, there is a shorter duration positioning for the portfolio as well because of the allocations to the dimensional global short-term investment grade fixed income and the dimensional global short fixed income funds. So those two funds are shorter duration, and overall the portfolio is positioned much shorter in terms of duration than the index, and that hurt performance, relative performance in Q1. Next slide, please, for the ESG. And then the last of our core portfolios would be the ESG portfolios. The ESG 100% equity portfolio performed in line with the MSCI equity, which is not ESG focused at all, really because the two things. The first one is that the portfolio had zero exposure to energy, which was huge and really contributed to performance. But it was offset. So this outperformance was offset by some of the underlying funds security selection, especially in the financial sector. And so that detracted. So all in all, that they just offset each other, and the equity portfolio performed in line with the benchmark overall. For the fixed income portfolio, also positive returns, but it lacked the index. And that's really because, again, I feel like I'm repeating myself, but it's very true. The portfolio had a shorter duration positioning versus the index due to some of the underlying managers. They were more focused on shorter term securities, and the overall positioning for the funds were shorter, leading to a overall shorter duration for the portfolio, which had a negative impact for Q1. And with the ESG portfolios, I thought it was important to highlight to our investors and our clients who are invested in this portfolio that they're not only receiving financial returns, but that they can see the impact that these portfolios are actually making in real life. So if you just go on to the next slide, what we tried to do was try to use metrics that were actually more quantitative, tangible, so that you can see the difference that the portfolio is making in terms of the environment and social issues. For here, for these, this is specifically for the 100% equity portfolio, because equity data is actually easier to get than fixed income data. You see that the carbon emissions intensity for the portfolio has been declining. So in Q4, you have that, Q3, you have that number, Q4, it declined, and in Q1 of this year, it's down to 99. So it's a lot lower than the index. And in terms of board gender diversity, the equity portfolio actually has a higher level of diversity versus the index as well. And the fixed income portfolio is not shown here, but just talking about it in a more qualitative term, we have an allocation to the PIMCO Climate Bond Fund, which has about 60% in green bonds, with issuers that are leading in mitigating both carbon emissions and also some other environmental externalities as well. The United Sustainable Credit Income Fund invests in companies that contribute to certain UN SDGs. Those in particular are 1, 8, 9, and 11, meaning like eliminating poverty, decent work and economic growth, industry, innovation, infrastructure, and sustainable cities and communities. So a lot going on there. With that, let's go on to the satellite portfolios, and this will be my last slide. All the satellite portfolios posted positive returns in Q1, as you can see on this page. For China, security selection and an overweight to IT helped, while an underweight in communication services detracted. For the fixed income portfolio, it also had positive returns, but and the exposure, various exposures, so offshore USD Chinese credit, renminbi Chinese credit, smaller extent allocation to Chinese government bonds, policy bank bonds, and currency fluctuations all helped, resulting in an overall positive return. Real estate also posted positive returns versus the benchmark. We actually had a negative return. This was mostly driven by performance in January, when optimism over the possible slowing of rate hikes led to a rally in the REIT and real estate sectors. The biggest contributor to the real estate portfolio is actually the BlackRock Global Real Asset Securities Fund, which had exposure to infrastructure and utilities, and that really helped with the performance. Mega trends, great performance, 5.4%, slightly underperforming the equity, even though the growth bias helped as growth stocks outperform value. The portfolio had allocations to two of the funds. The first one is the BlackRock Nutrition Fund, which had some stock-specific underperformance. AllianceBernstein Healthcare portfolio was actually underperformed versus the rest of the funds because it was actually invested in the healthcare sector. If you remember, it was one of the worst performing sectors for Q1. Technology, the largest monthly contribution came in January on the back of market optimism from China's reopening and strong consumer confidence in the other markets. Overall, for the quarter, all the underlying funds posted double-digit returns. So technology is really making a comeback in Q1. However, the portfolio underperformed the MSCI Equity Tech Index, mostly due to one large factor, which is that it's allocated towards smaller cap names, because we wanted to have that broad exposure to all caps, large mega caps all the way to small caps. And the index does not have exposure to small caps, and small caps underperform large caps, and that's why the bias hurt in Q1. Low vol had delivered robust performance. It has allocations to shorter duration funds, and that led to a downside protection in February when everything was down. But of course, that could not help. That did not help with the rally in March, and could not keep up. The portfolio could not keep up because of the shorter duration. And with that, I end my section and hand you over to Sean to go over income and cash smart.
Thank you, Min, for covering the first quarter performance review and for some of the portfolio performance attribution as well. So for the Endowus income portfolios, All three Endowus income portfolios delivered positive returns in March and for the first calendar quarter of 2023. By asset allocation and positioning, just a reminder here, stable income is the most conservative of the three portfolios, with 100% of its exposure to fixed income. Higher income is 20% equity exposure and 80% fixed income, and future income dials the equity exposure up even further with 40% equity and 60% fixed income. The underlying constituent mix is also slightly different. On performance, the three income portfolios underperformed the broad fixed income/equity benchmarks for March, and thus slightly for the quarter as well. Within fixed income, this was primarily driven by the portfolio's shorter duration and slight bias towards emerging markets. In the case of higher and future income, there was a bit of high yield exposure, and this drove a little bit of relative underperformance as well. Within the portfolios that hold equity exposure, again, higher and future income, as we know, the markets, as Min just shared, the markets had a pretty strong growth versus value reversal, where growth outperformed significantly the first quarter. So this led to a slight underperformance for our portfolios within the equity portion, as it has a bit of a value bias. In aggregate, however, performance was very strong for the quarter, and there was actually some capital appreciation seen across the three portfolios. So they were up between about 1.8% and 2.9% for the quarter. On the next slide, in addition to positive total returns for the quarter, importantly, all three income portfolios continue to achieve their payout targets. Payouts have remained very stable despite the fluctuation of prices across the three portfolios. Volatility of price returns have, of course, led to mark-to-market impact of the bonds and the underlying. Last year, this was very clear. There was a very strong negative mark-to-market impact. And from October last year into this year, there's been a positive mark-to-market impact as markets have rallied. However, there's no impact on the coupon or payments or dividend payouts of these underlying funds. As the chart below shows, the annualized payout yields have been rising as a function of stable monthly payouts and lower net asset values from late 2021 to October 2022. And they've actually been really stable since the markets rebounded in the fourth quarter and through the first quarter this year as well. The yields in the fixed income market have risen meaningfully following the increase in global interest rates. So this is obviously a positive for income-seeking investors. You can see the charts are basically positively sloped upwards as well. These portfolios pay out on a monthly basis to the order of 5.6% per annum for stable income, 6.2% for higher income, and 4% for future income. A reminder that future income has an allocation to equities, 40% of it. So there's a potential capital appreciation here as well. On to the next portfolio. For our cash-smart portfolios, reminder again, we have three portfolios here. We have cash-smart Secure, Enhanced, and Ultra. They're positioned along the risk and return spectrum. And obviously they have commensurate durations here as well, 2.3 months, so really, really short and really stable for Secure. Enhanced has a duration of close to 1 year, and Ultra about 1.6 years as well. On cash-smart Secure, it continues to generate stable and positive returns, averaging about 20 basis points per month, and thus it's up about 60 basis points for the year. For Enhanced, liquidity, the two underlying managers here, just to dive in a bit further, are Fullerton SGD Cash and Lion Global SGD Enhanced Liquidity. They continue to offer attractive yields that reflect the current backdrop of higher interest rates. On cash-smart Enhanced, this also posted positive returns across the 3 months of the quarter and is up about 80 basis points for the year. I'll just note one fund here, UOB United SGD Fund, captured some of the additional return from its sizable Asia bond exposure. There was obviously China reopening. We know that happened a couple months ago, and this lifted the fixed income markets in Asia as well. cash-smart Ultra posted a very strong January figure and slightly more muted February and March figures, ended up the quarter a pretty strong 1.2%. Okay, with that portfolio review done, actually, maybe I'll just go in these slides for a little bit as well. So you can see there, I think the takeaway from this slide is really everything is performing in line with expectations. As I shared, the risk and return of a client, this is how you kind of think about risk and return. So obviously, as the markets have rebounded all the way on the table on the right, what you'll see is the portfolio is skewed to a little bit more risk, have obviously commensurately returned a higher, yield and a higher total return as well. Okay, on the next slide, here are, the performance of the portfolios. So what you'll see is cash-smart Secure, the ever stable Portfolio is just upward sloping as yields have come up. Enhance and Ultra have obviously suffered a bit of mark-to-market drawdown over the course of last year and have rebounded pretty sharply into this year. Finally, on the yields, so this is just a forward-looking estimate of the yields that you can expect for the 3 different portfolios. So Secure is right around the upper 3% range. Enhance is between 4.1 and 4.4%, and mid 4% for Ultra. So again, this is something that clients can consider when looking to put their cash to work. Okay, with that, I'll move on to the market outlook and observations. So over here, this is a pretty busy slide, but really just kind of look all the way on the right at the top of the table. So if I just kind of walk you through the last 2 years very briefly, I think Min did share this as well earlier. The tail end of 2021 saw a very sharp rise in inflation, leading the Fed to embark on a very, very sharp interest rate hiking path. Since peaking in June last year, inflation, as painted on the page, it's been driven down somewhat. So inflation really came up to about the upper 8%. Really look at headline and core CPI. Core CPI means ex food and energy. They've actually had a sustained downtrend since peaking in the middle of last year. However, what we're noticing as well is actually it's remaining pretty sticky. So core CPI was at 5.5% in February. What we don't have here is March. The March figure was 5.6%. So again, fairly sticky and largely in line with the market expectations. However, this drop has come from some of the major inflation hotspots, such as the commodity spike post Russia's invasion of Ukraine. Strong supply chains and lower consumer demand have kept core goods inflation higher. Shelter inflation also remains elevated, although the market expects this to come down as rental prices do move down. These obviously rental prices move on a lag, so as these come down, this should also lower the CPI numbers slightly. Core services, this is one that a lot of the market participants are looking at. It remains pretty high on the back of a tight labor force and strong wage growth. So the bottom line for this slide really is inflation looks to be falling, but perhaps slower than the Fed would like. Again, 5-point-something% is really not in their target range. On the next slide. So obviously, if the economy stays stronger for longer, as mentioned by inflation, then there's the potential for rates to stay higher for longer as well. So I think this is a chart that we always use every quarter. It's the Fed funds rate. So this chart depicts the Fed funds rate expectation. So as shared in the previous slide, the Fed embarked on a series of rate hikes last year to combat inflation in the order of close to 5%. They started in March 2022, and right now they're getting close to 5% in rate hikes. Last month, they also continued on the rate hike path, moving rates up by another 25 basis points. Well, I think what's important is to read really what the Fed is saying now. So importantly, during the last month's meeting minutes, several Fed policymakers debated a pause during the meeting. And the market has taken this as a signal that a pause is really on the horizon as well. So really, when you look at the dot plot, so if you look at the lines in blue, this is where the FOMC participants are kind of plotting out. And the green line is where the market is. So the dot plot signals this potential for another 25 basis point rate hike on the horizon, which is the blue dots. But this is possibly the last. The Fed has a lot to consider: weaker growth, an elevated backdrop of inflation, lower unemployment than expected. So they're continuing on their path. The market disagrees slightly with the green dots here. They're broadly expecting a pivot towards the middle to later part of this year. And I think this is driven a lot by the expectation that there might be a market recession. But overall, I think another comment to take away from this slide is that the Fed looks like they've finally caught up with the market, and they're close to actually being in sync in terms of their rate hikes and expectations as well. So on this, what does the market really think? On the next slide. The market has stayed largely calm amidst all this headline fear. So obviously we know this quarter has been littered with a lot of negative news about the market. So what you see here is the VIX index. The VIX index is a real-time index that represents the 30-day expected volatility of the S&P 500 US equity index. It's also known as the fear index. And I think what participants can look at here, as an investor, you really look at this as a measure of market sentiment. So what I'll highlight here on the right in gray is the year-to-date move on the VIX. So the VIX has actually been pretty muted. So what we've tracked here is the beginning of last year, so the entire 2022, where there were many, many periods where the VIX spiked, but the average of that period was pretty high. And this year, the average, if you draw a line through the middle of the gray on the blue line, you'll see that it's been actually pretty muted. You can see there it spiked up on the news on March 13th when SVB headline hit the headlines as well. But it's been pretty calm under the surface. If we go to the next slide. So this really talks about, wanted to spend a minute talking about, the US banking system. Obviously, this is something that the market is looking at pretty closely. The collapse of Silicon Valley Bank and several other regional banks. And this was exacerbated further in later March by Credit Suisse woes, spooked investors globally, and that's why the markets really took a hit. People were scared this was 2008 repeated. So I think what we can chart here is really a few things. The big picture is that the US banking system remains fairly stable. And you can see that in the previous chart when the VIX was actually, it came down pretty sharply and it stayed at pretty low levels. So the slide on the left, the table on the left shows the US bank Tier 1 capital ratios. So Tier 1 capital ratio is really the measure of a bank's equity and reserves to risk-weighted assets. So financial regulations that came in post-2008, what you can see there, 2008 is painted there in the gray line. They drove banks to a much safer stance. So core equity Tier 1 ratios really moved up. So you can see there they moved from something to the order of 10% to about 13 to 14% today. So again, this means that banks have actually tightened their lending ratios and are a lot stronger position today. So we really don't risk global financial credit type crisis again. However, what I think is really, really worrisome, banking crisis averted, is really the knock-on effects of tightening credit standards of lending to small firms. So what you'll see there on the top right chart is, something that's been going on for some time. So we can see that the demand for loans for small firms has come down, and the tightening of banks lending to small firms has also come down. So you'll see that in the top right chart. And the percentage of banks tightening their loans on the bottom right chart has gone up as well. So really, when banks are tightening loans, the economy does slow down. This is a concern on the markets because there's an impact on economic growth, employment, corporate profits. And obviously, we know that the S&P and the US market has a pretty optimistic forecast for equity markets. And then with all these tightening conditions, the probability of recession is obviously driven up. Okay, I will segue a bit into fixed income. So on the next slide, I think something that a lot of investors are looking at, and we're seeing it, we've seen a lot of traction on our income portfolios, and a lot of investors have been buying a lot of fixed income products as well. So I think the reason for that is in the chart over here. So if you look on this slide, what you'll see is 10-year ranges, which are in gray, of different fixed income sectors. The 10-year median is in purple, and the blue diamonds represent the current yields of the different sectors within fixed income. So I think the takeaway here is that the diamonds are on the higher end of the 10-year range. If you just look at investment grade corporate bonds, they're yielding about 5.2%. So you really don't have to go down very far down the credit quality spectrum to get pretty healthy yields. And obviously, on top of meaningful income, higher yields also buffer against drawdowns. So a lot of investors have been leaning into fixed income investments. Okay, so next slide, please. One of the big questions weighing on investors' minds today is, are we going into a recession or will the market be resilient? So what you see on this chart here is the International Monetary Fund, or the IMF, they released a report highlighting a downward revision to its global growth forecast. So just a bit of legend here. The dashed line represents the IMF's GDP growth forecast in January 2023. And then the solid line is its March estimates for GDP. The colors represent the different regions. So you'll see there in blue, it's developed markets. In gray, it's emerging markets, and world is in black. So what you'll see is the three solid lines, which is the March estimates, sit a lot lower than the January estimates in the dotted line. So GDP growth estimates based on the IMF have actually been revised down further, i.e. global growth is slowing and the risk of recession has come up. Yet, as Min shared earlier, the equity markets are up significantly. MSCI World is up 7% for the first quarter. So again, the markets are not really agreeing with a very slow global growth as well. Okay, on the next slide. So I think the title here is pretty self-explanatory. So what we've done here is charted the week-on-week performance through the first quarter for global equities as measured by the MSCI All Country World Index, the broadest measure of equities. So what you have breaking down a quarter into weeks is 12 different sample sizes. So it's been a pretty roller coaster ride. You can see there, the bars are up and down. If we break down the 12 weekly returns for the quarter, you'll see that 10 of the 12 weeks were actually more than 1% move, and 6 of these were actually more than 2%. So you can see there's a back of headline news we're all too familiar with. You can see the week of Silicon Valley Bank and Credit Suisse was where the markets were down 3.6%. So it's been a pretty volatile quarter. And at the end of the quarter, this index was actually up more than 7%. So the takeaway on this slide is really investors really need to break the bad habit of looking at markets on a day-to-day basis. You take a step back and look at empirical evidence provided by history. If you'd slept through the first quarter, your equity portfolio would have been up close to 7%. Okay, on recessions. So in the next slide, I think this is again empirical evidence on what happens to equity markets. If you look at, trading a recession is near impossible to do, because one is obviously recessions are normally called after a recession has actually happened because there's a lagging nature of economic data. And economic data is obviously prone to being revised as well. So by the time you know you're in a recession, they call the recession, it's a bit too late as well. There's also little predictability in economic data to financial markets. So we just call on history and see what it tells us. So if you look at over here, this is the average return of the S&P 500 going back close to 100 years, and includes obviously 2020's drawdown, COVID-19, and 2022 as well. So the US equity market, it's typically a downturn happens as a result of growth or earnings falling, and markets react in a negative way. The peak to trough sell-off is close to the order of 30%. So in recent memory, the two periods we can call on are the COVID 2020 sell-off, where the markets in March 2020 sold off by 34%. And last year, peak to trough, markets were down 26%. But if you look at the first 3 bars almost, you see that actually the first 2 bars, 6 months and 3 months before a recession, the markets are actually pretty flat. And during and post a recession, 1 year, 3 year, and after, the markets actually bounce back pretty strongly. So that just means that an investor really, really just needs to stay invested. So again, if you slept through and you woke up 3 years after a recession, your portfolio was up 35%, your equity portfolio. And if you slept through and woke up 5 years later, you'd be up somewhere in the order of 50%. The next thing we need to remind ourselves as well using history is that the intra-year falls, basically the peak to trough fall during the year, is nowhere near the end of the year's returns. So this is a 32-year chart, 1990 through 2023 this year. What you'll see is MSCI World, which is a broad representation of equities. Intra-year returns are typically not as bad as the trough performance during the year. And obviously we know it's impossible to sell at the top, impossible to buy at the bottom. And if we look at this chart, if you have 33 sample sizes, 33 different lines over here. You've had actually 25 positive years and 9 negative years for equities. So it's been a pretty good period for equities as well. And so what this chart also reminds us is we really need to stay the course, not look at negative news and peak market drawdowns, and dollar cost average is one way to ride out this volatility and the uncertainty of recessions as well. Okay, on the next slide. So this is when market volatility increases, we really should think about, investors really need to think about their investment horizon. So we look across the equity markets, which are on the left, and the different time periods. So you have a time period from 1 year all the way to 20 years for global equities. And on the right side, global fixed income markets for a period of 1 year to a period of 20 years. And this talks to the dispersion of markets over the year. Just using the first bar on the left, what you'll see is if you invested in global equities for 1 year, your range of returns was the best year you'd seen is 46% up, and the worst year was down 42% in the depths of the financial crisis. If you really drag it out to about 5 or 10 years, your returns, be it in equities or fixed income, are close to positive as well. So if an investor has a close to 5 or more year time horizon, you'll see the dispersion of returns will actually be a lot tighter, and returns will actually be skewed in a positive way. So it's just another reminder that we should stay invested. And it's interesting, if you actually blend the two and diversify and buy equities and bonds, it's actually the returns look even stronger as well. Okay, I think that's it from my section. Perhaps, Min, we can open it up for some Q&A.
Yep. So there are a couple of questions. I mean, actually, there are a few questions. So I can take the first one, which is why are there two passive funds for the US allocation in flagship? Um, why not just use one passive US index fund from either BlackRock or Mundi? And I think the important thing to remember is that while both of them are tracking the US focused indices, the iShares US index fund is actually synthetically replicated. So it invests by buying E-mini futures, which are smaller S&P 500 futures contracts that are exchange traded. So that way you're not getting dividends, but the future contracts are priced such that it more than makes up for not having dividends. Without that dividend, you're not getting you're not subject to the tax withholding on dividends. So there is some upside to having that, but at the same time, the Amundi index fund is physically replicated, so you do get dividends, and it's also slightly cheaper than the iShares. So I think there is a benefit to having both, and it's also good to diversify the portfolio so that you're not just having one asset manager, but to have more. I think if it doesn't cost more, it's not necessarily a worse thing. So that's I hope that answers the question. And then there's another question, Sean, that maybe more for you. Is what's your outlook on inflation and recession, and which Endowus portfolio can be recession proof and protect against inflation?
Thanks, Min. Yep. So inflation, as I shared, I think when we look at the data, really, inflation peaked, as I shared, core inflation, core CPI in the middle of last year, and it's come down from 8%, but it's still sticking around 5.6% in March. So it's been sticking around at a pretty elevated level. This is obviously a reflection of the Fed hiking interest rates to kind of move inflation down, but it's been reflective of a pretty high rate at the moment, and the economy's been running pretty strong. So that means the Fed will keep rates higher for longer as well, to the extent that inflation is high for longer, right? So we'll see when that slowly comes down. I think the market expects it to kind of drift down further, but take a bit of time here. The recession call, I think this is a very hard one, right? I think I'll just one of the data points perhaps we can use to kind of talk about it. Well, I was at a fund manager conference yesterday, and what they did was they conducted a survey of about 300 participants, asking about what kind of recession we're going to get, right? So you could have four different scenarios just to paint: a hard landing, soft landing, no landing, even came up this year, and a stagflation environment as well. And the survey was really split between three different, largely a third between soft landing, hard landing, and stagflation, and 11% voted in favor of no landing. So very, very few people were in the no landing camp. And this was obviously run at the end of last month, which was post SVB and other regional banks going under, and obviously Credit Suisse as well. So I think if you run this poll a month earlier, things would have looked different. I think people would have been more on the kind of no landing or soft landing consensus. So the point there is really it's very hard to predict what kind of recession we're going to get. I think the market is pretty clear that we're going to get some sort of recession. And I think what's important to look at is two different things, right? One is the scenario that plays out in terms of growth or inflation. So in the case of a soft landing, you really don't have any growth, you have muted inflation, and that's actually pretty good. That's what a lot of people hope for. A hard landing is inflation goes down and growth also slows down, and that's very hard for the markets typically. Stagflation is the worst scenario, negative or no growth and then pretty strong inflation. And then no landing. I think that seems like at least it's off the cards. So the impact on asset classes also differs slightly. Credit, fixed income, and a lot of people are buying this. It's muted deposit returns. Typically in a recession, it basically has muted, not much return, slightly positive, which is pretty good. Equity swings a bit wildly. In a hard landing scenario, it goes down pretty strongly. Again, stay invested. And it's actually pretty positive in all other different scenarios. So, I don't know how this will play out, but again, when you look at the portfolios and you make sure you have the right investments and you're diversified, and you just have to make sure you think about staying the course and being able to stay longer. On the other side of things, if you don't have that time horizon, then perhaps you want to move really, really up in quality on fixed income, take a bit longer duration portfolios, or consider some of the money market type portfolios, because those ones will be very, very stable through all scenarios, and obviously the liquidity is there.
Thanks, Sean. Let me see. There might be another. I think some of the other questions have been answered by our colleagues already. There's actually one on, let's see, when will the CPF flagship portfolios be rebalanced using the lower cost funds? That's coming up. That's coming up soon. Let's see what. Okay, the other thing is, will Endowus continue to maintain overweight exposure to value, small cap, and short duration bonds for flagship portfolios? I think that the answer is that yes, because we do have the dimensional funds that are overweight these longer term drivers of expected returns, such as value, small cap, and profitability / quality. And these are actually have been academically shown to outperform over the longer term. In terms of short duration bonds, short duration fixed income acts like a protector in terms of, when things go bad, they tend to react less than longer duration bonds. So for the flagship portfolios, especially for CPF, we want to make sure that people are maintaining their capital preservation ability. So that's something that we will, of course, continue to monitor, but we don't expect to make too many changes to that part of the portfolio for now. John, maybe you have something to add to that?
No, I think that's clear. I was kind of just looking at one more question that maybe I'll move on. India. I think this is a very small market. Maybe just a couple comments from me. We really don't take very many kind of direct country calls. As you know, we stay very diversified. So India, when you look at it, they're already one of the most populous countries in the world. And then, the news that came out recently was that they would actually overtake China as the largest population in the world. I think on top of that, they're also the youngest. I was just doing a bit of reading on this. So more than half of the population in India is under 30 years old. And this is against 38 average age in US and China as well. So obviously that's positive from a demographic standpoint. However, I think India is really faced with a lot of, from what I've seen, a lot of challenges, right? They have poverty, hunger, malnutrition. They have issues providing health and education, infrastructure for cities, and making things more livable. I think they have a slightly different governance than China, so a little less organized in terms of a top-down. And then, climate change doesn't really help their issues on water and food and electricity as well. From a portfolio perspective, when we look at India as a percentage of the overall markets that are invested in a core diversified portfolio, it's actually pretty small representation. And that's a function of kind of the size of the average companies over there as a function of the overall population, world of investable assets. So, I can't really speak to the sentiment shift. It doesn't feel like, at least in the investors that we talk to, that there has been too much of a focus here over the last really quite a long period as well. But again, as it becomes more relevant, and as the markets do stabilize perhaps over there, that I think it will feature as a larger part of the portfolio, but that will be incremental over time.
Okay, I think that's all the time we have. We have 1 minute left. I don't know if you want to maybe talk about the webinars that are coming up.
Sure. Yeah, just a call out to some of the exciting events coming up in the next 2 weeks. So on Saturday, which is tomorrow, Sam will be hosting Mr. Liu on a Supercharging Beyond 1M65 event. So again, please register your interest here. It's at 3 p.m. tomorrow. And thanks for taking time out the weekend to learn about investing with our CIO and with Mr. Liu. Okay, next one is next Tuesday. So again, just 3 days after we have Sam and Greg, our CIO and CEO respectively. They will be talking in a lot more detail about our flagship portfolios, which obviously, as some of the Slido has alluded to as well, will be including both BlackRock iShares and Amundi funds in, investors are currently going into these, and we will be doing an RPC for these fairly soon. So if you're interested in finding out more, do tune into that webinar. Specific to iShares, and ask all your BlackRock iShares questions. Sam and Hugh is our Chief Investment Advisory Officer, will be on a webinar with two experts from BlackRock, Deb and Gear, talking about the passive index funds that are included in your Endowus portfolios and on the FundSmart platform as well. So those are the exciting webinars coming up.
With that, thank you very much for joining us today. We hope you have a great rest of the day and a wonderful weekend.
Thank you, everyone. Have a good day.